venture capital investments or the kind of private company investments that family offices tend to gravitate to, they are also doing direct. So they're not necessarily relying on venture funds to gain entry to those companies. So they're doing a lot of their own research.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. And guys, there's a lot going on in regards to the VC as well as the private equity and the pre-IPO growth stage companies in regards to alternative investing and how to do it and what to do it and what to look for. Well, that's the reason why we have this next guest on. He is the managing partner at Bombora Advisory, works with family offices, ultra-high net worth investors, venture capitalists, venture-backed companies, and its employees, institutional investors, trust companies, banks, and boutiques asset management firms to identify venture capital investing strategies, venture-backed company secondary trading, founder equity employee stock financing, being able to facilitate and navigate the right opportunities for family offices, ultra-high net worth individuals in the venture capital world. Before he started into this world, he was actually a derivatives trading equity trader for many, many companies, all the way back from 1998. So he's been in this industry for many, many years. Please welcome my next guest, the managing partner at Bombora Advisories, Mark Caccavo. How are you doing today, Mark?
How are you? Thanks very much for having me on.
Mark, I am looking forward to this conversation. Like I mentioned, you were a derivatives trader. And before we dive into all the venture capital world and your thesis and how you navigate that with family offices, ultra high net worth, I want to talk a little bit about when you were, working with numerous companies in the derivatives trading side of things. What skills did you learn during that time and that journey of your life to help you do what you're doing now?
That's a good question. I would probably say if you think hard enough about it, you can always find a way to a solution. And especially in the derivative world, there are a lot of moving parts to every transaction. And if you couldn't satisfy it with criteria 3 or 4, maybe you could in criteria, 5 and 6. So and the venture world kind of presents similar challenges where structure or accessibility or ability to have liquidity are things that must be overcome in some situations.
When you're looking at that, what do you mean by that as in, overcoming the liquidity? Well, help me understand that a little bit for our audience.
Well, I think the secondary market remains a mystery to a lot of people, and especially employees. You could have someone that was the first engineer at a company that's now a billion dollar valuation that's worth 25, $30 million on paper. And they may not know what liquidity options are available to them just because this is the first startup company that they've ever been a part of. So kind of navigating and how they present that to the marketplace is there's a lot of sensitivities to it. So, the company certainly doesn't want some big block of stock in the public domain for sale. Um, Investors are clamoring for information on the company because most of the time it's pretty closely held. So there's a lot of competing forces to get a lot of these transactions done, and it requires a lot of education and navigation. So it's not just you snap your fingers and there's a buyer ready to buy your stock at the price you want. So there's always some iteration of it that ultimately is what transacts.
This is a very good point because, like you mentioned, there is incongruencies or there's fragmented. There is no simple system where, hey, this is the buyer, this is the seller, I'm looking to sell this, whatever. So that's why you are so important, navigating that and facilitating the right relationship as well as the transactions. So walk us through a little bit about what you do on a day-to-day at Advisory there, being able to facilitate those transactions constantly or quarterly, every year. You're always working with very large companies and employees there, but also different secondaries.
Well, I think, it depends where the inquiry is originating from. So most of the time, I'm getting inquiry from sellers, and they are typically through a referral network. Once you kind of trade for a few software engineers at pretty high profile companies that have now gone on to be at another three or four successful technology companies as a software engineer, word can get out there and um, that you're a liquidity provider and people will reach out. Now, the tougher part, especially in an environment like we're in today, is to find the buyers. So the key to the buyer side of the equation is information. And maybe when the late stage and growth stage market was very active and very bullish, it was very easy for companies to or investors to kind of disregard maybe those last five items of diligence to before they wanted to pull the trigger on the investment. But now that's completely changed. Now it's a more of a demand of information, a demand of knowing the well-being of the company prior to pulling the trigger. So it was very quick how the tide changed from being a seller's market to a buyer's market.
Well, with that being said, because you're exactly right, private markets, private companies are not regulated as much as, obviously public companies where they have to, reveal everything to the public, et cetera, where you have access to all that information. Not saying that it's, illegal or anything. It's just that they don't have to, right? There's not a regulation. With that being said, just like you mentioned, these family offices or ultra net worth that are looking to infuse capital in buying that position, that buyer, they are looking for those KPIs, that information. And a lot of times you don't get out that information unless you are on the cap table or have deep connections with that company. So how do you navigate that with giving the right information, making sure that, hey, this is where the company's trajectory is, and then this is the possibility of getting X amount of shares?
Well, the good news is we always take a very friendly approach with the company management. We want whatever investor is going to be purchasing the shares to be a welcome addition to the cap table. In many cases, they could be a much longer term holder than the seller. So there's a lot of incentive to kind of keep that new investor happy. And I find that companies that are doing pretty well, that have management that's seasoned, that will be, they kind of have the management in place for a publicly facing company. They understand the role of IR and the fact that, you can have a new investor on the cap table that maybe found, $20 million of stock through the secondary market, but they would be very interested in participating in your next primary round. So we do try to position it that there are some benefits to the company, to the investors that we bring. And then obviously for employees, it's really important that employees pick sometimes to strategically diversify if they have one gigantic concentrated holding. Traditionally, that ends up being around a life event for many of these people. So what you'll see is you'll have the software engineer who joined the company at 27. Maybe he rose very quickly, and he got married when he was 35, but he had 7 years of options in a company that maybe is a $1 billion company now. So he's worth a sizable amount of money, but he's never really traded anything before. But now he has a life event. He's getting married. He's going to buy a house, maybe start a family. So he's going to take some off the table. So that's kind of, that's where I get a lot of calls for early employees. And the early employees can really do a nice job of explaining how the company works, maybe where they make the bulk of their revenue, what things they're thinking about. And to the extent diligence, I think in the private markets is very much triangulating on information. So, you'll hear it from one place, but then you're going to go look somewhere else. If you can talk to the management, great. We often, I have a partner, and sometimes we will actually take down positions from a seller because we like it so much, and we will show it out to investors through SPVs. And that information and that we're getting, and also that the company and developing the relationship with the company is super important to the ability to close these transactions. Because if no one's going to just buy it in a black hole these days at all.
No, you're exactly right, and I appreciate explaining what you guys do at Bombora Advisory that help facilitate those transactions, the underwriting, the due diligence process. You know what the buyer's looking for, yeah, and to facilitate that transaction. I wanted to pivot a little bit toward the venture capital. Obviously, we've had a huge boom and bust cycle, very, very successful in the last 10 years. Definitely the VC, a lot of money's been deployed. We've seen a lot of unicorns. We've seen incredible, results. We're starting to see a little bit pivot downward. Again, nobody knows exactly where the market's going. We just anticipate that. Obviously, we go through booms and bust cycles, like I mentioned, and but it's more about how to navigate it correctly. And I know you work very closely with family offices and ultra high net worth to navigate the VC. First of all, I want to get a 30,000 foot view. Okay, Mark, you're on the front line. How are you seeing the VC industry holistically at a macro level, changing and pivoting? And then I'd love the second part of the question is how are you kind of navigating the pivot of that macro industry?
Can you hear me? I can't hear you now.
How about now? Can you hear me?
Yep. Cool.
Okay, I
You're
apologize. I think the whole system went down on me, so I'm not sure what happened, but it was recording there.
Now, just so you know, your screen is very, very blurry to me, just so you know.
Okay, because you're coming in perfectly clear. I'm not entirely sure what's
Oh,
happening. I
good.
apologize. Um, but what we can do is my team will just edit this and we'll just keep going from the question that I asked here. Um,
That's fine.
Sounds cool?
Yeah,
Okay,
that's fine.
cool. All right. So, Mark, really, I think this is really incredible that we're kind of diving into this, and you work very closely. I want to pivot slightly to the VC world because I do know that obviously we anticipate the booms and bust of every generation. You were in 1998. You obviously experienced the 2000, obviously the 2008. You've experienced a lot of booms and busts. And it's not like you're freaking out. It's just a matter of how to navigate this. And you work very closely with family offices and ultra high net worth. And first of all, I want to ask Mark, at a macro level, okay, where are you seeing the venture capital industry pivot to? Are you seeing it in a positive direction? Are you still seeing a lot of money being deployed there? Or what are you seeing at a macro level? And then, of course, I want to dive into how are you navigating in these uncertain times in the VC world?
So the first question, there is a tremendous amount of dry powder on the sidelines, a lot. And there were gigantic venture funds that were raised in 21 and 20 that still have billions of dollars to deploy in the venture world. So I think there's, good companies are going to continue to have support. Um, I think the worry a little bit is the orphan portfolio companies, those companies that maybe are a little more later stage, but maybe they miss their window to go public and the growth is only mediocre. What do they do with those companies? Because they don't want to necessarily spend a lot of time on them, but they still have incentive to get them public as they may have been in the portfolio for 8, 10 years and they're getting a little they want to kind of close those funds and return capital on those funds. So I think certainly at the macro level, VCs have plenty of money to deploy. Um, the bigger family offices that manage their cash are certainly playing and selectively looking at direct investments. Um, as we discussed on the earlier call, I do think that the venture capital investments or the kind of private company investments that family offices tend to gravitate to, they are also doing direct. So they're not necessarily relying on venture funds to gain entry to those companies. So they're doing a lot of their own research. There's also been an evolution, I think, on the venture side where if you were an early stage and a seed investor in a company and you're getting your pro rata allocation on a primary offering, um, maybe when you invested in it, your pro rata was $1 million or $2 million. But now that the company is significantly higher valuation, your pro rata could be 20, $30 million. That could be two or three times the size of the fund you raised. So you obviously need to kind of um, build relationships with people that could be interested in that allocation with you. So the family office community has been very successful at doing kind of co-investing alongside venture funds on their pro rata allocations that they can't just satisfy internally.
Interesting. So that's kind of what you're seeing in regards to pivoting a little bit. And I'm noticing that as well. They're kind of walking away from the fund to more of that direct deal. Why do you think that is in regards to ultra high net worth and family offices where they're kind of, running point guard on their own underwriting a little bit? Is it because they don't really care for the fee structure, or is it because they can have a little bit more of, operational control over that a little bit? What have you noticed in regards to the heartbeat on why you're seeing that trend?
I think it's a couple factors. The first would be a lot of family offices have started to view their direct privates portfolio as the way that they want to satisfy the ESG component. So whereas before maybe they, invested in the public markets and used screeners to kind of have certain companies that fit their ESG requirements, it was much easier for them to go and say, okay, we want to invest in this clean energy company. We like the management and we have good access to shares and information. It's in a good space. We'll make that investment. So I'm seeing that's one thing that's happening. Certainly is like they want to be involved with the founders and be around that the positive energy of the kind of ESG related VC backed companies. And then I do think that fee structure wise, family offices are always happy to pay for a fee structure that's fair as long as they're getting some value. Because they have enough data points and enough ways to check to say, okay, what are the returns on your venture portfolio with the family office, the consortium of family offices that they talk to. There's a lot of sharing of ideas. There's a lot of sharing of fees. It's a very transparent. At least some of the major cities have very good family office networks that people can tap into to just see what's fair. Um,
Okay,
I
that
would
makes sense.
say, yeah.
Well, go ahead, please. Yeah, you would say. Go ahead.
No, I think uh, also the venture funds are running right now at around an 8 to 10 year exit. So by choosing some direct investments, they can manage kind of the maturity of their venture portfolio a little bit better. What we saw happen in the last year was there were so many companies that probably could have gone public in 2020, 2021. They had the metrics for them, they had the size, but the venture fund said, yeah, let me just do one more round. So they delayed that IPO even further. And now you're seeing a lot of those valuations that have come in. People are wondering if they'll even get back to that Series F or Series G price before it goes public. Then the last thing I wanted to mention was, if you kind of reverse about, let's say, 2012, 2013, when kind of really the market started, the tech market started doing extremely well. A lot of the big funds that were raised, the new bigger mega funds on the venture side, were mostly institutional investors, and there were very few family offices in them. So in some cases, family offices got squeezed out of venture funds that maybe they had worked with from a very young age of that fund. So, somebody's on Fund 12 and Fund 14, and they were with them for Fund 3 through 7 or 8. Now they're saying, okay, when we invested in this the first time, it was early stage and it was a $50 million fund. Now it's across every sector in venture, and it's a billion-dollar fund. Very different profile, return profile, very different investor base, and guys like pension funds that are happy to sit on investments for 10 to 15 years. It doesn't actually, it doesn't match as well with, let's say, a venture fund that has mostly family offices and ultra high net worth or boutique asset managers that are looking for specific timelines.
This is interesting. I want to loop back on one thing you mentioned, because a lot of VCs, and I've seen this pivot in a trend, they like to normally have like a five-year exit at some point, right? 5 years. And you've, just like you mentioned, we've seen that window extend to 7 to 10 years now. And like you mentioned, obviously, because I understand the private markets, you have a little bit more control, you can infuse capital, you can raise capital, but now the whole industry at a macro level is changing. So it's just interesting to have someone like yourself on that's able to talk like what you're seeing in regards to the trends. Now, I want to dive in a little bit further in the VC world. Okay, you get a nice, because you're on the front line working with family offices and ultra high net worth, you get a nice heartbeat of where they're deploying capital. Specifically, we want to talk a little bit about VC, but VC, it expands on a lot of different niches, right? All sorts of, SaaS, whether it's, very specific, whether it's technology, whether it's AI now, like that's the new hot, sexy thing, whether it's crypto, all these VC kind of funds, if you will, that deploy capital in these certain different stages of the company as well. So some are, series to, pre-seed to, Series A and so forth, and some focus on just Series A to Series B. Mark, you've worked with quite a few family offices over the last 12, 24, months. What have you noticed in regards to heartbeat on where these individuals are deploying their capital, where they're infusing their capital? Are you seeing that in a specific industry that's kind of really, getting a lot of capital allocated? And then also, at what stages are you noticing? Do you like to see some companies that are at Series A where they got some tailwind? What are you seeing overall, Mark?
I would say I would agree with you. The companies or VCs are deploying within, I would say, AI heavily. Family offices are looking at venture funds that are in healthcare and in defense tech. Kind of the things that are traditionally a little more resilient when the economy is a little softer. So those venture-backed companies that are in those spaces are getting a little bit of attention. Certainly, earlier stage companies where the valuation is very much in check are getting more attention than later stage companies. Doesn't mean that there aren't great opportunities in the late stage market. They're just, you have to look for them a little harder. Most valuations for earlier stage companies for seed and Series A are coming in very reasonable, and the founders understand that cash is very important to them. So family offices, on the flip side, only want to invest in companies that understand and control their burn, and have deep management. And it's certainly not the growth at all costs model that was being deployed, let's say, in 2021.
Interesting, and that's really good to hear. They're kind of building the foundation, and I've seen somewhere, like you mentioned, where they're negative, EBITDA, and they have not even hit positive EBITDA, but they're valuated at $1 billion. Very interesting. Mark, let's talk a little bit about when you're looking at making these connections, because you're a facilitator and you're very good. But before you obviously look at the buy or sell, you make sure that there's an alignment. And I think it's really cool how you're very strategic in regards to making that approach and having that conversation and facilitating that transaction. Mark, what is your process in regards to, okay, hey, I'm going to work with this company that's looking to sell X amount of dollars, maybe this employee, and finding a family office that wants to obviously is a buyer. What does that process look like to make sure that, hey, because you've got a very filtered process. You don't work with everybody. You're very strategic on who you work with, and you're very selective, which is really nice. That's what makes you top notch on this in this advisory service. So how do you walk through that process and finding the right buyer and seller and making that alignment?
I think it depends on how the introduction comes in. Sometimes it's someone, like I mentioned, that could be, have a very sizable position of a private company that has never traded in the secondary market, or it could be someone that's extremely seasoned in the secondary market. So I usually try to bring them up to speed educationally so that we're both working and looking at the same information and digesting it the same way. Um, uh, what you don't want to have happen is you have a buyer that has a clear advantage over the seller. Like, that's no fun for me, being the facilitator of that transaction. They always say that you always know it's a fair deal because no one's satisfied. And I really, truly like stick to that. Um, so I think that educating people and showing transparency and building that trust early on, that's the interesting thing. You have someone that comes to you, they have their whole net worth is in one stock, and they're looking to sell half of their net worth. They don't know you from Adam. And I think to build that trust and ability to know that they're going to be treated fairly, they're going to be educated on the process and handheld is really important for those first time sellers. And then on the flip side, for people that are more seasoned, it's what are their touch points? What are the areas that are the biggest concern to them? Do they want to know deep dive on who's the management? Where do these people come from? What's their background? Do they care about who their customers are? Is there a way I can help them as a family office? Do I know I'm 2 degrees of separation from the CEO? Can I meet the CEO? So everybody kind of has a different touch point, but the key is, I think, in this business, in the private markets, making someone comfortable with who a buyer or a seller is or the company is very important, and facilitating that through the network and making those connections to the CEO, et cetera, is very important.
I want to talk about something that's a little minute, but I think it's very important because obviously, just like you mentioned earlier on, we saw these companies valuate very, very large, which means that if you're looking at sell, your price per share was like $100. But now, because the valuation went down, let's just play this example out. Now it's $80 a share. But obviously the seller still wants $100, but the buyer that's coming in potentially looking to buy, they understand the market and they want to buy it at $80, like what its value at. Now again, that's just an example, but there's a difference between the bid and the ask, and that conversation, that dialogue, and obviously the market has to embrace the truth of the new valuation, and the seller has to embrace that experience. You're laughing. I want to talk a little bit about how you navigate that and what you're seeing in the market right now.
There are certain companies that trade frequently and they're very active, and I think everybody knows what companies those are. And then there are companies that will have a flurry of activity for 2 months, and then it'll be radio silent for another year. And so once you're in this business a little while, you understand that you make hay when the sun shines. And if you want to buy shares and there's a little bit of activity in the name, that's when you can buy them. So it's not quite as easy as one would think to be on either side of that transaction. In terms of pricing and valuation, that's where the secondary market is getting better. So there is a lot of sharing of transactions or things that each different broker dealer has for sale. Um, the broker dealer the platform that I sit on, which is called Rainmaker, there are about 30, probably about 40 or 50 reps that most of them are in the late stage growth stage space, and so there's a good sharing of information in terms of where things are trading. But some companies, there just is no bid. And if a seller wants a particular price, the worst thing that they could do is put it out at a price that's a dream price and then lower it and then lower it and then lower it because they're offering against themselves, and the buyer sees that, and then the buyer will throw out some crazy bid and say, okay, fine, this is good for 2 weeks. And if they really want to sell, they'll probably sell it there. But they lost their negotiating power a little bit because they were just trying to be too greedy in a market that's not giving them any credit.
Because of the discrepancy, do you feel like that, and this is very, very individual to this time right now, and I understand this, but do you feel like, obviously, because the valuations are going down, the seller has, because it was a seller's market, years back when valuation, boom, you could sell it, it was top dollar, but now it's more of a buyer's market now, and the market kind of has to embrace, and some of these employees that are looking to sell or have a liquidity event. Do you feel like that is, or there still can be a negotiation in regards to, hey, there's still, whether it's, going through this 2 years, this well, let's take Stripe, for example, it went down from 60 billion. It's going to go back up to 160 billion valuation, whatever it was, and just anticipate that. What does that conversation look like? I'm just intrigued because I do know that you have to navigate that for the buyer and seller. And like you mentioned, if the seller is like, hey, I'll take $50 per share, when the valuation just 6 months ago, 8 months ago was $100 a share. Well, that's you've lost that negotiation power. So, and I know you have to facilitate that.
Well, I think one of the nice things about the private markets is if I have a good buyer and I have a good seller, I just get everybody on the phone together. And in some cases, I even will step out, and then that buyer and seller can have a direct conversation with each other. Maybe the seller can say, look, these are some things that I'm concerned about. This is why, or the buyer, I'm sorry. So the buyer can come in and say, these are some things I'm concerned about. Is there any information that, or any kind of insight that you can share with me that would make me comfortable? Because then maybe I am willing to pay a little bit more if I can verify some data that are concerns for me. So the sooner the two sides are talking together, the more likely a transaction can happen. Um, if people are just playing the telephone game and everybody's relaying, well, they want it for this price, well, I don't want to sell it for this price. That's no way to operate in this market because no transactions will happen that way. People want information.
So don't nickel and dime it. Just really sit there and say, hey, you know what? Yeah, I'll accept $83 a share. Sure, the market may be $50 right now, but you know what? 80 because also I see the trajectory. This is what's going on in the company and other things, etc. To share the story of what the value is behind it. Okay, gotcha. That makes sense. That's awesome. Mark, are you seeing a lot of capital with ultra high net worth and family offices? Are you seeing a lot of capital deployed in pre-IPO companies? We were just talking offline about this, and I want to loop this in because I found this interesting. Because these individuals have been illiquid for many years now, and they're seeing that extend out. I'm seeing there's a little trend slightly different. Are you seeing the same thing where that growth stage, where deploying capital in that growth stage, there's still activity, but just not as much compared to others? What are you seeing, Mark?
I think certainly on the very late stage market, like those companies that are viewed to be some of the first to go public or maybe even get acquired. I actually think let me take a step back. I think there were many companies that people felt were on a path to IPO that actually may have an M&A potential exit, coming into play. So that's also really important when people are thinking through a late stage company. So one of the things that happens in an M&A transaction is the preferred shareholders are paid first. So if it ends up being somewhat of a take under because a company's not doing well, the common shareholders could get wiped out. So there's a very important understanding of the cap table structure, how much they've raised to date. So on the larger later stage companies that have raised billions and billions of dollars, if for some reason they were to get acquired, you'd really need to understand the waterfall and who gets paid when in an M&A transaction to determine what the real value for, let's say, common stock is for employees. So there's a lot of moving parts right now with respect to late stage. I am seeing employees thinking, okay, originally I thought this would have been public and the lockup would have been off by January of 2023. It's not public yet, so it's at least a year and a half, 2 years from now. There's some activity in the company in the secondary market. I'm going to peel off 10% of my position. So you are seeing people needing to kind of fund for a few extra years at higher valuations. The question really is, can you find buyers at prices that you're happy with? And in some names, they are, but not all names. There are a lot of names where there's a lot of buyers and a lot of sellers, and $20 between the two. So
$20 between the two. They're very, I like that quote. Mark, when you're working with these individuals, I would imagine you have probably had some experiences where you got it down to the 5 yard line and you were so close getting it over to the goal line. And for whatever reason, one buyer, one seller decided not to at the last minute, and you just had to work with it. Mark, explain, maybe just a case study, maybe a situation that did happen, and then what you learned from it. Maybe certain red flags. You're like, hey, I spent way too much energy, and I knew there were certain red flags that were going off, and I should have stopped it at the 30 yard line or whatever. What did you learn from those experiences?
well, the one experience which I can't elaborate on because it'll probably end up being a Netflix or a Hulu special of a tech company. But what I will say is transparency and everybody not having self-serving interests is what gets transactions done. Um, the more that people are speculating, why would someone do that? What are they trying to do? Why is there a delay? That's where people get uncomfortable. And so that can happen. You can get that comfort level with someone if you've had 5 or 6 transactions with them and maybe they bought other companies and you have that rapport with them. But often when as I mentioned, if you have a group of sellers that this is the first time they're selling stock, they don't trust anybody, which they probably shouldn't. You really have to be careful in this marketplace because there are a lot of people that make misrepresentations. So the one thing I would say that's the most crucial is that you're working directly with people that actually have the buyers and sellers, and it's not some daisy chain of people that a broker of a broker of a broker, because no transaction, the likelihood that a transaction gets done, it falls to probably 10% if you have 4 people in that transaction. If I'm crossing stock in my own network and there's a price match, that's like a 98% close rate. If I am working with one of the 5 guys, men and women that I trust in the industry and that have similar approach to the business and inventory as I do, then that's probably a 90% chance. But the moment that you add one other person in there, it immediately drops to a 50% chance. And then if you add more than that, forget it. So when talking about, where is there a lot of time wasting, that can often happen when you get inquiries from outside the U.S. that have many people involved in it. You're not talking to the end clients. That's kind of a waste of everyone's time.
That's actually a really good point, because like you mentioned, I've seen where it is, daisy chained out, and you're not really talking directly and you're playing phone tag, and that's never fun. Mark, when you're and those are good things to explain. Do you do like micro commitments, on the buy side and the sell side to make sure that, okay, these individuals, are okay, you are looking to sell, you got $10 million in company A, you're looking to sell 5 million. We got to have some sort of agreement, a micro commitment, not saying that, you're going to sell it, but it means that, hey, I'm going out there and finding it, and I want to make sure that there is, supply and demand. Because obviously you don't want to go find a buyer and all of a sudden that $5 million guy says, well, I don't really want to sell at the last minute for whatever reason, right? And then also on the buy side, there's probably a letter of intent or something along that line to make sure that they are qualified purchasers before the conversation or the negotiation even starts, to be able to mitigate, like you just mentioned, mitigate that risk of nothing happening and increasing the probability that it will convert and transact.
I agree with that. On the seller side, mostly it would just be our kind of a fee agreement. Our fee agreements, it's not unique because most places do it this way, but there are two different fee agreements. There's someone that's actually getting paid a retainer and they are shopping a block and they're expecting that no matter what transacts, they're going to be paid. Our structure for when we're buying and selling stock is only success based. So, it's up to me and my introducing them to a buyer to get paid. It's the risk that we take, but I think after a while, the things that companies you can put in front of and which clients to put them in front of, and either there's a bite or there's not. So there isn't a lot of endless shopping of a lot of these transactions. So we should be able to figure out pretty quickly if something can get done.
Yeah, I think this is just important because for those that are looking to deploy capital in this market, for the first time that they're doing it, it's good to understand the process, but also it helps you understand, helps those that are listening that have already done it numerous times the way you do it, and very simplified process, making sure that these individuals obviously align. And I think that's why I wanted to have you on our podcast, because just being able to talk and have these conversations and really navigating these uncertain times, but also there are opportunities. You just got to understand how to work it, and partnering up with Mark. Mark, man, I really appreciate our time together, man, and learning from your experience, the way you're able to make these alignment, finding the buyers, finding the sellers, navigating, facilitating, having those right relationships. And, you're a very relational person. I can tell that right on the front end, and that's how you work your business and advisory services. Mark, for those that want to reach out, connect, I do know you have a cool webinar and stuff like that. How do they reach out to you? I know we're going to put that link in the description below. What happened? My end, but can you hear me okay?
There he is. Oh, look at that. Okay. It was funny because it just showed on the top of your box, it said actual recording is much higher quality. So, because I can't, I should take a screenshot of like
Exactly. It does. It does. I apologize.
basically you look like a character from Minecraft. That's about the pixelization you have.
Oh, it's really that bad. Oh, wow. That's so bizarre because you're coming in really clear. I apologize on that. I may need to buy a Starlink or something like that because my internet's
But
been a little shaky.
but it's very funny though because I'm laughing because it literally is like I'm having the conversation with like a avatar of you, not you. So anyway.
and avatar some random little thing. But hey, let me finish this up here, and then we can cut up the recording. First of all, really good stuff thus far. I'm really excited about it. But let me do a little outro, and let's rock and roll. So give me 1 second here.
Okay.
Mark, man, thank you so much for being on our podcast. I had the greatest time just learning so much from you, from your experience in the derivative side to then really navigating and facilitating the right alignment with the buyer and the seller and the venture capital and these, growth stage and late stage companies. There's just so much fragmentation, but I can tell you're obviously on the relational aspect, definitely as your advisory services and being able to facilitate the right relationships with these buyer and sellers and navigating the uncertainty. It's always changing, definitely in these environments. Mark, I do know you have a really cool webinar and so forth for those to reach out and learn a little bit more, but and I know that link is going to be in the description, but how else can they reach out to you, Mark, my man?
I think just certainly through the website Bombora Advisory and through the link that you'll put in the podcast. Feel free to reach out. Definitely happy to talk about situations that you may have, and most importantly, provide some education so that people can make smart decisions and not operate in a vacuum in the secondary market.
Very well said. And guys, those links are in the description. I'll put his LinkedIn, the website, as well as that other description there. So it's all in the description below. And my friend, I really appreciate you being on here. Guys, that is the managing partner at Bombora Advisory, the one and only Mark Caccavo. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.